Hi there, I'm Pamela Ambler, and it's a pleasure to have your company. Welcome to I See Your Trade, the show that looks ahead with fresh insights and data-driven deep dives. On this episode of I See Your Trade, we are looking at big tech. 5 of the biggest companies in the world are big tech. 6 if you include Tesla. Apple is the world's biggest company, and to give some perspective on its size, Apple's market cap is on par with the entire GDP of India. I'll be joined by our guest, Zach Murr, CEO of Lyft Global Ventures, who's based in London. And we are going to be talking about whether big tech is too big, and perhaps are they now too big to fail. I See Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets. Now let's start by setting the scene. The world's first trillion-dollar company emerged in 2018. It was a technology company, and its name, Apple. In the years following Apple's debut, 3 more tech companies joined the trillion-dollar club. 4 if you count Tesla. To put this into perspective, there are fewer than 20 countries with trillion-dollar economies. The last 5 years is the first time in history that single companies are worth more than entire countries. The rise of big tech has created the biggest personal fortunes ever seen and a new class of hyper-rich, the centibillionaires. They don't just have fancy cars and houses, they have rocket ships. So how did big tech get so big? The answer can be found in America. All the members of the trillion-dollar club are based in the United States. Perhaps not surprisingly, Wall Street also got rich from big tech. The likes of BlackRock, Vanguard, and Legal & General all made bank. Ordinary Americans also hitched a ride on this fast car. About $6,000 invested in Tesla a decade ago would be worth $1 million today. Now there's a whole army of Teslanaires. President Joe Biden promised to crack down on big tech in the lead up to the election, but even he's gone quiet. This is in contrast to China, which has been heavy-handed on big tech. Remember the world's largest IPO for Jack Ma's Ant Group? It went quiet after Chinese regulators interviewed Mr. Ma. What's next for big tech? Will it keep getting bigger, or will regulators start slicing and dicing to regain control? Love it or hate it, technology is certainly here to stay. Chances are you're watching this podcast from your Apple iPhone or Google Android device. I'm joined now by Zach Murr, CEO of Lyft Global Ventures, an investment firm that focuses on financial media and technology-focused companies. After nearly 5 consecutive years in the green, 2022 certainly isn't the year for tech companies. Shares of Apple have slumped almost 10%, Microsoft is down about 15%, and the tech-heavy NASDAQ has slumped around 20%. What's happening here?
Well, I think it's there are various factors. The pandemic actually saw tech stocks boosted, so we had a sort of overshoot on the upside, and I suppose we're having a correction from those elevated levels. 20% for the NASDAQ and 10-15% for the blue chips is not really, I think, a big deal. 20% I suppose is the line in the sand in terms of a bear market, what we call a bear market. So if you're down 20% from the peak, then you call that bear market territory. But we're just flirting with that, and as far as I'm concerned, there isn't too much to worry about, given that we were much worse 20 years ago in the dot-com times.
And what is behind the correction in tech valuations?
Well, there's 2 things. One, as I mentioned, there is the pullback from the pandemic. During the pandemic, tech stocks got a real boost. We were more aware of how important it is to be online, and services such as Zoom and all the other communications devices really came into focus. So I think even if we weren't going into a period of high inflation and higher interest rates, there still would have been a correction from that time. So that was almost like the bubble, an echo of the bubble in 2000.
And this time there is stimulus money behind that as well. The valuations where they are right now, Will it go further? Is it permanent, or will it be short-lived?
I think it'll be short-lived because of one or two factors. The main factor is that we are still in a tech boom time. The awareness of tech stocks is, they're the rock stars. The companies are Elon Musk is almost literally a rock star. So the people involved, the protagonists, are still very much in the limelight, and the necessity for innovative tech is still there. So those factors haven't changed. I just think that what we're seeing now is a combination of a post-pandemic cooling off, and then that aggressive Fed stance that we've had in terms of interest rates, trying to get rid of that excess liquidity.
Right. Now, on the regulation front, Joe Biden went into the election promising to crack down on big tech, but he's seemingly gone quiet. Why do you think that is?
I think one of those situations is that with tech is that they become a victim of their own success. Many of the companies that we know about have monopolies or near monopolies, and governments and regulators start getting a bit uncomfortable. But it is that this regulation or potential regulation is actually just a factor of success. And if you are somebody who is a capitalist, let's say, you would probably want to see as little of that regulation coming through as possible. There's also the fines that you get from the likes of the EU as well. But I think that's almost a cost of doing business rather than anything else.
Now, China, on the other hand, seems to be taking a very different approach than the US when it comes to big tech. It's implementing laws on personalized algorithmic recommendations. It's introduced laws to limit internet addiction. Why is China taking such a drastically different approach to the US in terms of regulating tech?
Well, I think one has to be polite when it comes to talking about China. It's kind of what they do. It's a very regulated environment. They obviously want to see that the people in that country are not getting any alien types of input in terms of the content and the media that they're looking at. So that's understandable. And at the same time, they see very strong US companies in the tech space, and they don't want the US to have a monopoly in that space.
Right. Now, one of the problems with big tech is that they gobble up other businesses. One of the highest profile is perhaps Facebook's acquisition of Instagram for $1 billion because it was a threat to Facebook. Do you think regulators will start stepping in to prevent these type of mega mergers?
Well, I think it depends, who do you trust more in terms of doing business, the regulators or the entrepreneurs themselves? As I alluded to, and it is a situation that in many tech spaces and many tech areas that in order to succeed, you need to have a monopoly or a near monopoly situation. We've seen that with Microsoft, we've seen that with other companies as well in terms of individual services or products. And I think it's just a fine balance, and it's almost a political decision rather than a business decision. But I think there will be certainly more headwinds for tech companies. And in a way, the more successful they become, the more that risk comes through.
And we know a lot of people made a lot of money from the rise of big tech. Has the growth in big tech peaked, or is tech still an opportunity?
I think the opportunity is dependent on the way you look at tech. The way that it was 20 years ago was very much looking at the software and the technology itself, whereas now I think with, let's say, sort of tech 2.0 that we've had in the last, say, 5 years, it's actually the companies who become utilities or become indispensable to consumers, which are the ones that are, will win. So there's obviously a great debate at the moment whether, the Netflix subscription, which was for many people a utility, such as water and gas and everything else, some people are now, getting rid of that subscription. But the companies which can resist that, even in a downturn, economic downturn, are the ones where they've got the the ratings in the markets of a tech stock, but they also have the surety of earnings that you would expect from utility, and that is why tech is so fantastic for people who are in this space or want to invest in this space. That if the tech is good enough and the company is good enough, it will become as reliable as in terms of investment as a utility would be.
Are there any challengers to the $1 trillion club, or will we see the $1 trillion club dominate for the foreseeable future?
I think that's a very interesting question. It's almost like looking at the world at the end of Jurassic and seeing all the large dinosaurs roaming around, and then wondering whether the little rats crawling around will actually ever be able to to supersede them. I think the beauty of tech is that not only from an investment point of view, from other perspectives, that the relative cost of setting up a tech company is the capex is relatively small. The success is really dependent on how good an idea is, rather than actually how much money you necessarily spend. So that, from a tech investor's perspective, is what is great about this area. So for $1 million can turn into $10 billion, but it's very difficult to do that with a supermarket or a sort of everyday product in the old economy.
And because we are on a VODCAST, you can see the charts that we're talking about. So if you're listening via audio only, we encourage you to turn on the screen now so that you can see the charts. But for our listeners, we will also talk you through the data. Let's jump into the data. So this first chart, it shows the big tech companies and their performance year to date, the decline so far. Why is this so significant?
Well, in terms of what's happened year to date, I think that the real message here is that we've seen a normal retracement, which you would expect with any market after a period of excess growth, let's say. So the magnitude there of 10, 15, 20% is something which is perfectly normal. And I think that given the conditions, the macroeconomic conditions and the uncertainties, I think we've actually got away with a relatively small a retracement, a normal one, whereas maybe with factors such as Ukraine and rising interest rates, it could have been much worse.
And if you compare today's tech correction to the dot-com crash, are we seeing any similarities?
I think, fortunately, I'm not. I think it's a much more mature market than we had 20 years ago by definition, so we've got 20 years to get it right, and for the strong to survive and the weak to fade. The analogy of actually the dot-com crash is perfectly illustrated actually over the last year with the cryptos. So you've had the magnitude of the decline in Bitcoin from 69,000 to I think it was 18,000 at the worst, is almost the same as we had in the dot-com. So the cryptos have had their dot-com moment, and on that analogy, you would expect the recovery to take the same sort of time that we saw back in the noughties, and that's, I think, a very telling thing. When you have a new technology, new idea, the volatility is greater, the retracement's going to be, well, the rally's going to be greater, and then the retracement's going to be greater. 20 years ago, Amazon rallied to $13, it came back down to 90 cents, and then it had its big rally, but it took a while to get back from 90 cents. So we have not had what I would call an exuberance crash in tech over the last year to date. We've had a typical correction which you would see in any market.
This next chart shows that it took about 5 years to recover from the dot-com crash. Will it be roughly the same time frame this time?
I think with, I think that the tech correction that we've had is just a normal everyday correction. The analogy is not the same. That's really for crypto watchers to assume that the rebound from the exuberance rally that we had in that space over the last 5 years will take, it could take 3, 4, 5 years to come back, because people have actually overdone their investment in that space, overdone their enthusiasm, and it will take a while for confidence to come back. The tech area, I think, is underpinned by the diversity we have. Alphabet, Meta, they're all in very diversified spaces within tech, but they are companies which are not necessarily economically sensitive or sensitive to the economic cycle as well. So I think we're in a much better position than we were when the dot-coms and the tech stocks fell then. Now we have a situation where you have very strong companies which have effectively become utilities, and they are near to being monopolies. And in that kind of environment, they can withstand much more than they could a couple of decades ago.
We saw earlier that a few grand on Tesla a decade ago minted a whole army of Teslanaires. Is Tesla one of the one-off opportunities, or are there others?
I think there's some aspects of Tesla which are one-off. I think the Elon Musk is a phenomenon, and in a way he's the Warren Buffett of his day. He's the Pied Piper, and so there is I think a premium in the valuation of that company. But at the end of the day, even though he might say, and people might say, it's a technology company, what underpins the valuation there, from my mind, is ironically that EVs are set to become a utility, and he's got first mover advantage, and those are the kind of things which helped tech stocks in the 20 years ago. So companies that had first mover advantage. He's effectively got a monopoly in terms of the perception of the company and the position of the company in the market, and that means that I think he will continue to be very, very strong indeed.
So you're really betting on the founder as opposed to the company itself?
I'm betting on the founder there because I think there's a premium because of the founder, but I think the position as his first mover advantage in EVs, which he's effectively got, and the brand are the main drivers for the valuation. And what underpins the valuation is that EVs are said to become an everyday, almost non-discretionary item, and that is going to be the real thing the real driver for the valuation going forward.
Zach, can you elaborate a bit more on how you believe that tech now is more of a utility?
I think the reason that tech stocks have ballooned in valuation over the last few years, and especially in the wake of the pandemic, is that through the pandemic and obviously beyond, we've seen what tech is indispensable, what is non-discretionary, what is a SaaS model that won't be cancelled, what is a subscription that won't be cancelled. And the companies where they have that sticky revenue, those sticky earnings, have now shown through since the pandemic. Obviously, in the case of Tesla, we've become much more, carbon neutral focused, carbon net zero focused as well. So you've got the situation there where it's almost become a necessity that we convert to electric vehicles. But across the board, over the course of the last 2 years, we've seen that we have to have our Zoom calls, we have to have our Apple subscriptions, etc., and that is really I think has been the driver that we've seen now that tech can be as needed as utility stocks are or utility items are. And that's why there's been that extra boost in tech valuations. And the trick now going forward is to find companies and products which will become indispensable and non-discretionary, and also obviously in the current economic environment will not be affected by potential downturns economically.
Zach, you had mentioned also some of the pandemic consumer behaviors that are here to stay, such as the grocery shopping.
Yeah, I think the issues like the grocery, the online shopping, the groceries, etc., that has obviously fallen away since the pandemic, and I think that's a good illustration of how the market has tried to readjust itself to decide whether it's a product or a service is actually non-discretionary and will keep going, it's a necessity, or whether people were just using it over the pandemic. And you could explain some of the pullback in valuations with companies which are very pandemic focused in the tech sector coming back. But nevertheless, I think that that was a great stress test for tech companies, and they will emerge stronger once they sort of tweak their offering so that it becomes something which is also works and is also needed in the post-pandemic environment.
Thank you so much for joining me, Zach. That was Zach Murrah, CEO of Lyft Global Ventures. In summary, yes, big tech is big, and while it's taken a knock this year, it's certainly not down and out. You've been listening to episode 2 of I See Your Trade. I See Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade out to IC Markets. In our next episode, bear markets are usually short-lived following a conflict, but with Western influence being diluted, Russia still at war with Ukraine, and China-Australia relations strained, which regions and sectors will bounce back quickly from the conflict? Thank you for joining us today, and we look forward to seeing you next time.